Today, hey, welcome, Jim Manning here and Caleb Davis. We are talking some real estate shop today. And what's interesting about investing in real estate? One of my favorite things is that it's made more millionaires than just about anything else, hasn't it, Caleb?
Yeah, I remember just growing up my entire life, I always heard that, and I was always intrigued in real estate. I'm like, man, this thing's got to be pretty cool if it makes more millionaires than any other career field. And then more millionaires own more millionaires own real estate than don't own, like, obviously, right?
Yeah, absolutely. And then then the question becomes, okay, if investing is in real estate is a good thing to do, should I invest passively or actively in real estate? And what the heck does that mean? So when I say passively, Caleb, what do you hear? What does that mean to you?
Yeah, so to me, passively means completely hands off. I do nothing. I put my money in, my money goes to work, and I'm done. A lot of people, when they hear passively, they think they have a rental property that they're managing, that they're doing the maintenance on, and they think that's what passive is. But that's really just being a landlord. I think there's three very distinct levels, if you ask me, to like the traditional rental setup. You have what most people think of, which is your small one guy show that he does all the maintenance, he does all the management on a note section of his phone, or maybe he has a spreadsheet, right? There's almost no background checks, like very little insight of who you're renting to. And then you have the step above that where people usually graduate when they get between 10 to 20 units, sometimes 30, it depends. And they bring in a management company and a maintenance guy. And still, even if you have a management company and a maintenance guy, there's still a lot of work that goes into it. People at this point still think this is passive, but it's not. I built a portfolio very similar to like how I was just explaining, doing the BRRRR strategy, and I was buying rentals. And starting out, I was doing the maintenance and doing the management because I was like, oh, that's going to keep more money in my pocket. And then as I realized, I got around I think I was at like 17 units. I was like, I can't manage this anymore. I'm not doing background checks efficiently. I'm not making sure that I have quality tenants going into these properties. And I was so worried about giving up 6%, is what the management company charged me, my first one, 6% of my rent, in order for them to manage the people. And the craziest thing is I got that time back. That 6% paid for itself because I was able to go over here and do more activities, buy more rental properties.
Yeah, so there's a difference between like actively building a rental portfolio, a real estate empire, so to speak, and investing passively. And what's interesting is a lot of people don't even realize that there are passive options available, and we're going to get into that in a second. And when I say passive, I mean it's like buying a stock on the stock market. You stroke a check and you sit and forget it, and you let other people do literally everything. So we're going to talk about that in a second. So as far as active goes, Caleb, when you were building kind of like your initial portfolios was over 10 years ago, I believe, like when you started, right? Let's get into kind of the nut and bolts and like what the strategy you choose and what you did for that.
Yeah, so I started out so my first house I bought was a house hack. I moved in a very crappy home, fixed up as I lived in it, rented the rooms out. I was able to keep my cost of living next to nothing. Then I did 2 creative financing structures to where I needed no money into the deals, and they were value adds. So I did an 8-family that had 3 units that were barely inhabitable. The other 5 are completely uninhabitable. I was able to take over the note of the seller. And then eventually I refied, and they actually carried still part of the note so I could get a bank loan to cash them out. And that was a 5-year repayment. So within 5 years, I had to have the seller completely out of the deal. So it was nice. It gave me the opportunity to get an 8-family. Took me about a year to turn that building. I just went in nights, weekends, one unit at a time. I'd get first month's rent deposit. That went to Home Depot to buy more materials. And then after that, I started to get a little money. Well, I had 10, 20, 30 grand. And then the BRRRR strategy started, which a lot of you guys have heard BRRRR. For those of you that don't know what BRRRR is, it's buy, rehab, rent, refinance, repeat. And I would buy a property, we would rehab it. I was still performing a lot of the work, so I was keeping my costs very low. Very, very active, though. I mean, I was working 40, 50, 60 hours a week on the job to build this portfolio. But it allowed me to go from 8 units to, I went up to 50 units in about, I think it was probably 3.5 years. And my best year was like 20 units in 1 year. And it was just all from turn and burn, turn and burn, turn and burn. But that is very, very actively investing. Was I an investor? Yes, but I was also a landlord as well. And
Yeah.
then
Now you used now you did use a passive investor to help you with the capital that you got going, correct?
correct. Well, so that was it. Not for the burrs. That was for my flips. So I was flipping
Okay.
houses at the same time that I used a passive investor for.
All right. So
That-
yeah, so break down that relationship and how that worked.
yeah. So I did my creative structuring deals. I did a few burrs. I flipped some. I did a couple of flips on credit cards as well to get initial capital. And then I had a portfolio. Essentially, I put together this binder, and it was thinking back to it. It was very archaic to what I would present an investor today for. But yeah, I put together this little binder of these deals, and I was like, hey, here's the returns. Here's where your returns would have been. And I think I gave him 50. So I got hourly wage while working on the job sites, and we split the profits 50-50. My hourly wage was not crazy high. It was just a normal like $15 an hour job is what I was getting paid. And he was really happy because when we flipped, he got half the profits. I got paid for working on the job still, and we had really, really good spreads because the work was being self-performed.
So you had the time and you had the hustle, and
Absolutely.
his decision was, well, he's going to do all the work, and I have the treasure, I have the money. Is this somebody that I can trust to put money into to get a return back out? And that worked really well. Like you guys made a lot of money together. Right?
Yeah, no, it's we did our first year together. We did, I think, 8 flips. I was doing burrs on the side as well. So all my burrs, my idea was I want to do my burrs on my own. I want to keep those properties on my own to build my portfolio. I think I was about 24 at this time. And it was very much so like flip houses to make cash that pays my living expenses. And then we made way more money that year than we expected. And so that we did 1 year, we did 8 properties, and he was like, hey, I made enough money. I'm happy. And he decided he was done. He was going back to the stock market. 9 months later, he came back and wanted to flip more houses with me because we got such good returns. But I never also would have gotten that without having some type of proof. I had to have proof of concept to be able to get him to work with me.
Absolutely. So then what's interesting is you have the same deal, and you have, from one person's perspective, it was completely passive, and from your perspective, it was completely active, right? So even on like the exact same deals, like these can be both passive and active. So and I guess like the moral of that story is that when in real estate's involved, there's somebody that has to be actively doing the work. Like it's not a free lunch. It's a full-time job. It's a profession. So in the case of Caleb and his journey, when he started out, you had a lot of time, you had the hustle, you had the love of real estate, you wanted to get into it. You just needed a capital partner to help you put some of these deals together so you could work together.
Yeah, it's a lot of people like talk about, oh, you don't need money to invest in real estate. And it's true, you don't need your own money, but there has to be money somewhere. Money's got to pay for this because wholesaling, flipping, that's a job. You're not a real estate investor if you're wholesaling houses or flipping. You are working a job. Investing is putting money to work and letting it grow. Sometimes it requires a little work there, but the passive rentals and then the complete traditional rentals and passive rentals are both investing in my eyes. Some people may disagree with me on that, but that's the way I look at it. Flipping and wholesaling is a job. Rental properties is investing.
Yeah, that's right. So then at some point, someone needs to do the job, and you can turn a active portfolio, if you get the right property management and the right team in place, into more of a passive opportunity as well. So for Caleb and people that have a lot of the time and the hustle and the love of real estate, and they're okay with either a second job or turning this into their full-time job, the active investing is an amazing opportunity, and it's a wonderful way to go about it. And my journey is very similar. I had the time. I started out investing 14 years ago, and I didn't have any of the capital, so I had to kind of hustle and make things work 14 years ago. So then, as far as the passive opportunities go, there's a lot of different options. There's a lot of different opportunities, and we're not going to cover all of them in this, but why don't we just go into just a couple examples, Caleb? What do you think? Hey there, if you're looking to get the ultimate edge for your real estate investing company, go to dorseydeals.com/invest for more information. Just so you know, a high percentage of the people that we interview on this podcast are actually already Three Doors Network members. And our network members have a lot of extra resources. They have access to an online training vault with over 3 years worth of content in it. They have access to vendor savings like our Home Depot discount that's literally saved thousands of dollars for members. And we have a weekly group coaching call, and we have a lot of other great things as well as part of the Three Doors Network. So make sure that you check it out on doorstodeals.com/invest. There's a lot of different options. There's a lot of different opportunities, and we're not going to cover all of them in this, but why don't we just go into just a couple examples, Caleb? What do you think?
Yeah, so there's quite a bit of, and this is actually something I didn't really know existed until I was in the real estate space for 3 or 4 or 5 years, that some of these structures existed. So some of the stuff we're going to talk about, if you never heard about, is very high level. And if you have more questions, you can always reach out to us too, and we can explain some of these. So the first thing you hear that to me was a very, very hot word about passive was syndication. The last 2 years, I felt like everybody wanted to talk about syndication deals. And that is when there's one deal and one set of investors to one deal. Typically large multifamily apartment buildings. The returns are very all over the place, and the ceiling's high and the floor is very low. Wouldn't you say, Jim, with the syndication multifamily?
Yeah, there is, you know what, you just gave me the idea. Let's break down this like in a lot of detail. We can really focus on this in a lot of detail, but yeah, so the syndication is, it's kind of the same thing as a property flip. You're hoping that the market's good when the construction's done, and that everything goes right, and then you put together and then you resell it. The reason why you do a syndication over a property flip is instead of there being maybe $200,000 on the line, you're buying a $30 million apartment complex. So you want to pool a bunch of people's money together and do a syndication. And then try and flip that apartment building, fix it up, put tenants in there, and then resell it to somebody else and turn a profit that way.
Yeah, so syndications, the ones I've been presented and seen are typically 1 year, 2 year deals, and they'll try and come in and say this building across the street, say this is a multifamily building right here, say it's dilapidated and run down. So the rents might be, we're just going to say $500 for easy math, but market value might be $750. So syndication is going to come and try and upgrade the building, raise those rents to get the value of the property, and they're going to try and sell it to someone who's going to hold it for longer. So yeah, that creates a very, very high ceiling reward, but also very, very low if you guys fail. Like there can be losses for sure.
Yeah, and then there's operators that are doing all the work, and then there's just the passive investors. The limited partners is another name for it, that are putting the money into the syndication and then hoping for the return. And I know there's a lot of deals that have gone really well, and it's definitely a high risk, high reward play. Like it's something that you can make a lot of money on. It is a good opportunity, a good option for when you have the right team that's working on the real estate and you have the right opportunity. It's a great way to make some good money. And the interesting thing about it is when it comes to real estate too, is you don't hear that like about these alternative investments. Like there's people investing with a self-directed IRA. And rather than just having all their net worth into like mutual funds or the stock market, you name it, real estate, you can take that money, that retirement account money, and put it into real estate if you're wanting to diversify and get into real estate.
That was something you guys taught me that I had never heard of at all in my life until I came over to Three Doors, that you could take an IRA that's designed for the stock market and put it into real estate. And I was like, this is so cool. And then another very passive investment, and I don't want to say the wrong words for this. It's like lending money for hard money loans. So hard money lenders, they borrow money from private investors, completely passive. This is a very, very safe level. You know exactly what your interest rate's going to be, exactly what your return's going to be. Very safe. But
yeah, absolutely. Yeah. And so this is, I can't speak for everybody's structures. The way we have done it is for the last 14 years, we have 100% success rate. We currently have about $28 million in our private lending program, and the 100% success rate of getting the promised returns. It doesn't matter if the real estate deal is a home run and makes, $100,000 plus, or it doesn't matter if the real estate deal ends up losing money. The investors on this play are getting money, steady Eddie money on the loan that's secured and backed by real estate. So it's a really nice play. Absolutely. It's a great play for passive income.
Yep. And then the final structure that I am seeing popping up a lot and is getting way, way more common is like an LPGP fund structure. So you hear hedge fund or real estate fund. And those really can be all kinds of different setups in the way they work. They're becoming much more popular because they're a much safer tool than maybe a syndication, and there's a lot more rules, so investors are a lot safer, from my understanding and my knowledge, in the LPGP structure than maybe a syndication.
The biggest difference on the structure with the syndication and the LPGP is it doesn't necessarily when you're looking to make an investment, it's really more about like the investment you're making. The structures are for like an apartment complex. A lot of times a syndication makes sense because it's a $30 million project and someone's just wanting to do this deal and then maybe kind of be done. But if you're planning on doing, and it's a very common way for real estate investors to start out, because if they haven't done one before, the plan isn't to necessarily do 10 or 15 or 20 different apartment complexes. It's maybe to just kind of do the first one. Whereas like a fund structure, the advantage of that is like, if you want to do 10 or 15 or 20, or in our case, we buy a lot of single family real estate. A fund structure makes sense because you're not redoing every time you buy a new piece of real estate. You're not redoing a syndication and bringing in more people every single time. You have the group of investors together in one entity that's then able to do the multiple deals.
And then when you're doing multiple deals, what that does is it creates a lower ceiling but a higher floor. So you don't have as wide of a range as maybe a syndication where there's one deal. You have a lot. So there's 3 different levels of passive investing: very, very safe, more risky, and then a safer bet where your gap is not as wide.
Yeah, and so like anytime you're flipping, and ask me how I know this. Wait, I've learned the hard way. Anytime and this is like stock market. This is really any investing. Is anytime you're like trying to buy and sell it and have more of a short-term window, the market conditions and what's happening in the world around us become a lot more important. But if you're doing a long-term investment, where, hey, you're buying something that you think is at a good price and a discount on day one, but your exit strategy is 5+ years down the road, any sort of short-term market volatility, you're not really exposed to. So when you look at, whether to do a syndication deal or whether to, there's long-term buy and hold funds out there, whether to look into options like that, or whether to just strictly do a debt play, that's the risk is something to definitely weigh in. And it really, it varies on a case-by-case basis based on the investment that you're making. So, Caleb, did my ADD take over? Are we?
No, you're fine. To me, like the biggest piece of advice to give you guys is be diversified. Make sure that you're diversifying across all of your investments that you're doing. Get high risk. Make sure you're in high risk and low risk investment opportunities, because you want to make sure that you're safe with your low risk money, and then it's fine to put some money in maybe a higher risk structure as well. So that's my biggest advice. I've always had great success with mitigating the different types of investments I'm doing, and it's worked really well for me.
Yeah, and it does depend on what stage in life you're at too. Like if you're younger and working on acquiring your wealth, that's different than if someone's acquired their wealth and looking to preserve and maintain it too, right? So yeah, absolutely. So I'm trying to think. I mean, I think we've covered the topic. There's not really much else I can think of on this. I mean, at the end of the day, just realize that there's a lot of great options out there, and I feel like we're a little bit pre-programmed to just think of mutual funds or the stock market or things that financial advisors will talk to us about and tell us about. And then on the other hand of the sign, then they tell us to diversify, but they're telling us to diversify within the sandbox, within the box that they play in. Right. And there's like this whole nother alternative vehicles out there that are help with diversification that are in real estate's case. It's asset based, it's four walls, it's a roof, and it's not based on the whims of how a stock market is feeling about a company, right? Like you have that tangible asset in play. And for the last several years have been over 95% of my personal net worth is in real estate. And I've been thinking about getting out of real estate to diversify a little bit. And with the current environment, I'm not able to do that. Like we have with inflation, with some of the uncertainty with the stock market, I am personally, I'm doubling, tripling down on real estate for the next several years. I'm gonna keep and stay into real estate because I'm so bullish on what I think the market's going to do. So I would say that. I mean, Caleb, how are you feeling about real estate and your own?
Yeah, no. So I'm super, super confident, super bullish in real estate right now. I was feeling a little scared because just like you guys, I see the news headlines. And then those of you guys that know me know I really like numbers. And I looked at the numbers of what we're looking at, what's going to happen. We can do another episode on that. Or if you guys ever want to chat about my prediction of real estate, I'd love to jump on a call with someone. So just message me on Facebook. I'm extremely confident through next year we're going to see single digit appreciation with a good, healthy market. But coming 2024, 2025, we're back to big appreciation years. It's the best time to buy real estate for the next 6 to 7 months. We're going to see in the next 10 years.
Absolutely. So, I mean, here's the thing, guys, like, we're happy to help you anyway. You know, if you're interested in trying to figure this thing out, should I actively invest? Should I passively invest? We're here to support you. The best number is just to give us a call or text us at 314-310-4886. We mentioned earlier about the debt vehicle that we have. So this past year, what's cool about it is it's been about $186,000 per month in passive income that we've generated, and the structures that we're doing and that we're setting up is for that passive investor. It's a great opportunity. So if you have any interest at all in investing into real estate in a way that's as passive as buying a stock on the stock market, and diversifying a little bit into real estate, we're here to help you. So the first step is just to call us 314-310-4886. And we can get the ball rolling. So that's all I got, Caleb.
That's all for me. Thanks for tuning in, guys. Hope you have a great Christmas and stay warm these next few days.
All right. Appreciate you guys. That's a wrap, guys. For additional resources, go to doorstodeals.com. And don't forget, we're already generating over $186,000 per month in passive income for people in our world. And we're just getting started, and we can help you out as well. So if you want to grow your passive income, we have multiple options available. The first step is for us to get to know each other better. Give us a call or send us over a text message at 314-310-4886 to get started. And finally, go out, live your purpose, and above all else, go after your dreams. Till next time. Thanks for tuning into this show. For more episodes and resources that will unlock doors to deals, check out our website, doorstodeals.com.